We're back to where we were at the beginning of the year. You know, the central banks are buying, China's buying, wealthy Middle Eastern and Asian people are buying, but North American are still selling. And I think that's a reflection, to preempt your question, I think that's a reflection. We know why the central banks are buying, because, and this is a point I would make, I think gold is going to continue to go up. And certainly even in November, I was thinking of a shorter-term correction. I wasn't thinking, or what I said is it would have been healthy. I think that source of buying is going to continue to be very strong.
Amidst evolving global economic conditions, gold continues to command attention in investment circles, with seasoned natural resources expert AdrianDay providing compelling insights into the precious metal's future trajectory. We know why the central banks are buying, Day notes, maintaining his bullish stance despite earlier contemplating the possibility of a short-term correction in November. The current market landscape verifies Day's perspective as gold strengthens its position against global uncertainty. Market analysts point to several key drivers sustaining gold's upward momentum: aggressive central bank purchasing, persistent inflationary pressures, and escalating geopolitical tensions. These factors collectively reinforce gold's status as a premier safe haven asset, although market observers acknowledge that price volatility remains an inherent characteristic of the precious metals sector. Day's analysis provides essential historical context for understanding gold's performance under varying economic conditions. During periods of financial strength, such as when optimism surrounded Trump's policies and inflation remained stable, gold typically saw reduced inflows as investors pursued growth opportunities elsewhere. Recent market dynamics have provided fresh evidence of gold's traditional market relationships. A weakening dollar following key policy announcements triggered a notable 1% increase in gold prices, even as conventional buyers in markets like India temporarily reduced their participation. This price action reinforces gold's historical tendency to thrive during periods of monetary uncertainty and geopolitical instability, demonstrating its enduring value as a portfolio stabilizer. While short-term price movements remain subject to various market forces, the fundamental factors supporting gold's role as a strategic asset. Before we continue, subscribe, hit the bell icon for updates, and share this video with friends or anyone who might find it helpful.
Well, first of all, let's say that the XAU, which is the US index, from the beginning of last year is up 19%. So let's not cry too much. You know, it's up 19%. That's not so bad. You know, everyone's complaining because it's not up as much as they would like, and their stock isn't up, right? I think there's two reasons for it. We go back to why gold moved over the last 2 years, who was buying and why they were buying. Well, the People's Bank of China is not going to buy Newmont for their reserves, let alone are they going to buy Ajax Exploration. They're trying to move away from the dollar, and they're just not going to buy gold stocks for their reserves. The same goes for Chinese consumers, who are the number 2 source of buying. The same goes for the wealthy families in the Middle East. You want to protect your assets. Protection means physical gold. It does not mean Newmont or Ajax. And so the reason that gold has moved over the last 2 years, and the people buying and their reasons for buying, really explain 90% of the reason, in my view. And then we come to where we are right now. I am surprised that there's ongoing outflows. There's no question about that. I am very surprised that there are outflows in gold and gold stocks at the moment in North America. But the reason that we don't have massive inflows is perhaps a little easier to comprehend, and that is that the economy seems strong, and Trump's going to make it even better, and inflation is under control, and Trump's not going to do anything bad there, and the dollar's strong, and Trump's going to make the dollar even stronger, and the stock market's doing well, and Trump's going to make the stock market even stronger. Why do we need gold? And so the narrative is just not, at the moment, is just not favorable to gold investing. That'll change, and I think it'll change when, well, we talked about that, when the stock market rolls over, and when it's obvious that the economy is extraordinarily undervalued right now. You know, you look at Agnico, which is now the second largest gold mining company, and I pick Agnico because nobody can point to Agnico and say, oh, that's why it's cheap. You point to Barrick and they say, oh, it's cheap because of Mali and Pakistan. There's no reason why Agnico is undervalued. It's going to end the year, we think, estimates, fourth quarter hasn't been announced yet, but it's going to end the year. Now, typically, when the gold price moves up, the margins expand. So you're in a situation where you've got a high gold price, you've got expanding margins because the price of oil and the commodity currencies, I don't need to talk about the Canadian dollar, but the same is true of the Australian dollar. The Australian dollars are, 68 cents, 67 cents or something. 10 years, 15 years ago, it was trading at a premium to the US dollar. So the cost inputs for the miners, both to run a mine and to build a mine, although some of them are moving up, not the Canadian dollar, but the price of oil, some of them are moving up, but the costs are not moving up as much as the price of gold. So the margins are expanding. The stocks are cheap. They're under-owned. I think the setup is just perfect for gold stocks. But you just have to be patient.
Central banks continue demonstrating a strong appetite for gold, with notable activity from key players shaping market dynamics through late 2024. According to AdrianDay, a prominent voice in precious metals analysis, China has resumed its gold purchases following a brief pause in June, contributing to what appears to be a robust year-end performance for central bank acquisitions. Recent data supports this trend, with central banks adding 53 tons of gold to global reserves in November 2024. While the third quarter saw purchases of 186 tons, comparable to 2022 levels but below 2023's record-setting pace, the National Bank of Poland emerged as the quarter's dominant buyer, incorporating 42 tons into its reserves. China's re-entry into the market has attracted particular attention. After a 6-month hiatus, the People's Bank of China resumed its gold purchasing program in November, increasing its holdings to 72.96 million fine troy ounces from 72.80 million ounces in the previous month. This development carries additional significance as it could potentially reinvigorate Chinese investor interest, which had notably declined following the PBOC's decision to end its 18-month buying streak in May. Looking ahead, the World Gold Council's 2024 survey reveals continued institutional interest in the precious metal, with 29% of respondents indicating plans to expand their gold reserves in the coming year. Let's get back to the interview.
The central banks are buying again. China, as we know, which has been the largest buyer, had been the largest buyer of gold for 2 years, but paused back in June. They're back in the market in November and December. So we're going to finish the year. We don't have the year-end numbers yet, but we're going to finish the year, if not at an all-time record high. It's going to be a strong... So the central banks have come in, have picked up buying. China has particularly come back into the market. And then North American investors have gone back into selling. So we talked about, I know how, the North American buyers were just beginning to come back in. But now that's reversed as well. And so if you look at, for example, the GLD, which is a physical ETF, GLD since US Thanksgiving, not your Thanksgiving, but American Thanksgiving at the end of November, there's only been 4 days of inflows. Every other day has been an outflow. You look at a GDX, which are the senior stocks, a GDXJ, which are the so-called junior stocks, they're both getting outflows again. And significant, steady outflows. So we're back to where we were at the beginning of the year. And, the central banks are buying, China's buying, wealthy Middle Eastern and Asian people are buying, but North American are still selling. And I think that's a reflection, to preempt your question, I think that's a reflection. We know why the central banks are buying, because, and this is a point I would make, I think gold is going to continue to go up. And certainly even in November, I was thinking of a shorter-term correction. I wasn't thinking, or what I said is it would have been healthy. But the reason central banks have been buying for the last 2 years haven't gone away with Mr. Trump. And if anything, with Trump threatening 100% tariffs on any country that dares move away from the dollar, that does not make South Africa and Brazil say, sorry, we didn't really mean it. It makes them want to step up their defenses against dollar weaponization. So, I think that source of buying is going to continue to be very strong. And the second largest source of buying is the Chinese retail and consumers. And they're buying because they're worried about the economy, they're worried about the yuan, they're worried about real estate, record number of house foreclosures in December in China. And they don't want to put their money in a bank because the banking system is a little bit fragile. So gold is going to be a beneficiary there. So I think those trends are going to continue. The real question is, when does the North American and European, but the Western investor, particularly the North American investor, turn from selling back to buying? I think the market is now overly pessimistic and thinking there's only going to be one rate cut this year. And I think it's only one next year, isn't it? I'm not sure. But certainly they've cut back on the expectations. Just as, I don't know if we said in November, but certainly back in September, I said the market was overly optimistic about the number of expected rate cuts. But I think right now, saying only one rate cut this year is overly pessimistic. It seems to me fairly clear that Powell and the Fed is fully aware, they're fully aware that inflation is not where they want it. Right? They've said that. Inflation is not where they want it. Their target is 2%, and as we've discussed before, 2% is a totally arbitrary target. But they know full well that they're above 2%, whether it's 30, 40, 50% above 2%. And they also know that the move from where we are now down to 2 is difficult. So they're aware of that. They're also aware that there are indications in the economy that are not positive, particularly for people at the lower half. We talked last time about credit card defaults. Well, now you've got credit card write-off, where the banks just are writing off the debt, and those are now moved up to record highs.
Gold's enduring appeal is highlighted by the resumption of purchases from central banks, especially China, which strengthens demand amid ongoing global uncertainties. With inflation rising and geopolitical tensions intensifying, gold remains a reliable safe haven investment. This trend of increasing central bank reserves will likely push gold prices higher in the coming months, reinforcing its position as a long-term asset for protection and diversification. Do you think gold will continue its upward trend in the coming months? Drop your thoughts in the comments below. We'd love to hear from you. If you found this information helpful, don't forget to like, share, and subscribe for more insights. Thanks for watching.